10-year yields hit 16-year peak as Fed seen higher for longer. Guys, the market is fundamentally changing over the last 40 years. We've been trading through a deflationary environment, and that has now started to change. If you stick around for the next 10 minutes, I'm going to tell you exactly what that deflationary environment was like, what we've been trading for the last 40 years, and how to prepare for this new market environment. So let's go ahead and start really quick by showing the 10-year yield on TradingView. I want you guys to see exactly what I mean by about a 40-year period of deflationary forces, right? If we go and we look at the peak of about 81 and we shift click down to about the bottom of August 2020, we see that for 14,000 days, right? So this is a very long time period. The 10-year yield has consistently hit lower lows and lower highs. This has given the market an opportunity to form these intermarket relationships in a deflationary environment that have become very, very normal for us to trade. Let's actually look at those really quick and I can show you exactly what I mean. Go over here to intermarket analysis on Chart School, on stockcharts.com, and we can see that this deflationary environment, these are the types of intermarket relationships that we are normally seeing. This is what we've been trading for the last 40 years. Let's start with inverse relationship between bonds and stocks. Think of your typical 60-40 portfolio, right? When stocks go up, bonds typically go down. When bonds go up, stocks typically go down. It's a nice hedge. I don't know if you've been paying attention, but over the last 2 years, the 60-40 portfolio has had the worst 2-year performance since its inception, right? Since it became popularized in the 80s. Also an inverse relationship between commodities and bonds, positive relationship between stocks and commodities, and an inverse relationship between the US dollar and commodities. This is very, very normal. This is what we have been trading through for most of us our entire lives, right? The deflationary environment, you see stocks down, commodities down, dollar up, bonds up. Another type of deflationary environment, stocks up, commodities up, dollar down, bonds down. But that stocks up, bonds down, or bonds up, stocks down is very, very key. There's an inverse correlation because it makes more sense to own stocks in a risk-on type of mindset, and it makes more sense to own bonds in a risk-off type of mindset. This is how we have been trading, most of us, our entire lives. But what happens when all of a sudden, on a macro time frame, we see that 10-year yield break that trend? This is no longer hitting lower lows and lower highs. Going back 30, 40 years, we are now potentially on the precipice of a new inflationary environment, right? Where maybe, just maybe, like we saw back from the 40s through the 80s, we are going to be struggling with keeping inflation under control. That doesn't mean the market is going to crash and we're all going to die. It just is a different set of intermarket relationships that we need to take into account. And I do believe there is a strong probability that we have entered an inflationary phase that could run for multiple decades potentially. Before anybody says the Fed has to step in and do something, I want to let you know that we did run for 13,000 days, or 13,000 days prior, from the 40s to the 80s. We traded through this type of environment, right? Market participants traded this. So this is not out of the realm of possibility. And I want to prepare you guys just in case we have entered this type of environment. So let's scroll up to the inflationary relationships here. And I do want to point something out really quick, where is it? An inflationary environment. Keep in mind that an inflationary environment does not mean runaway inflation. I think that's what's important, because in this entire video, I'm going to continue to reference this inflationary environment. It doesn't mean that we're going to be seeing 5, 6, 7, 8, 9, 10% inflation for the next 10, 20 years. I have no idea. It simply means that the inflationary forces are stronger than the deflationary forces. And so maybe the historically low rates that we are very accustomed to trading are just not going to manifest themselves anymore. We're going to be trading in a higher rate type of environment. And that's okay, as long as you know that the intermarket relationships change. For example, there's a positive relationship between bonds and stocks now. Instead of an inverse relationship, there's a positive relationship, and we are seeing that play out right now. We'll look at that in one sec. Bonds changing direction ahead of stocks typically happens. Did we just see that? Did we just see bonds take a dip before the market started to dip about 2 months ago? Maybe. Inverse relationship between bonds and commodities, and an inverse relationship between US dollars and commodities. So let's go ahead and look at this really quick. Let's look at that positive relationship between bonds and stocks. So you see the 10-year, once again, potentially breaking out into a new higher high. Let's pull up your 30-year ETF, right? TLT, and let's go ahead and bring up SPY. So this is your basic stock market versus bond, right? The stocks versus bonds comparison. Looking at the S&P 500 through SPY, and we're comparing it to the 30-year bond ETF TLT. All right. Back in March of 2021, if we scroll back a little bit, you can see that there is an inverse relationship going back a long time here between bonds and stocks. You can see every time bonds start to pop, stocks tend to fall off, and when stocks pop up, bonds tend to be weaker. That's the normal stuff that we're trading through, right? But what happened in the middle of 2021, March? We started to see the new bear market form. And what have we noticed since then? I outlined it here with this red circle. All of a sudden, bonds and stocks have started to move together. Black line is TLT, orange line is SPY. If I move this really quick, you can see generally they are moving almost perfectly together. Market went up, bonds went up. Bonds started to drop. Look, bonds peaked before the market, and then the market dropped. Bonds potentially caught a bid, started to find a floor. This is what kind of gave us this bull market idea for 2023. Stocks used that opportunity to rally. Bonds started to puke first, and then the market started to follow. We are now starting, at the very minimum, to have a positively correlated relationship between bonds and stocks. And just like this inflationary relationship says, this is very common in a potential inflationary environment. It's important to understand that because, like I said, the intermarket relationships start to change. Maybe, just maybe, buying the Magnificent Seven or tech, the big mega cap growth stocks, and just forgetting about them as a trader, not as an investor, but as a trader, is not going to yield the same types of results as it has over the last few decades. Because obviously, specifically the last decade from about 2010 to 2020, 2021, you couldn't go wrong buying mega cap growth. Are we still going to be trading through that type of environment? I don't know. It's going to be different. I'm not calling that out right now, but you need to understand that we are moving through a potential inflationary stage here that could span decades. It could. I'm not saying it will, but it could. There's one more thing I want to point out really quick. If we look at something like XLE, let's go ahead and take SPY off here. XLE, your energy ETF, is pressing into 14-year highs and potentially all-time highs. Not that far off. What I want you guys to understand is after the dot-com bubble, through the GFC, we are under the impression that mega cap growth stocks, Apple, Microsoft, Amazon, Tesla, these names are always going to lead the market and outperform. But there have been periods in the relatively near, past where that wasn't the case. XLE and some of the value areas led the market for almost a decade from 2001 to 2008. I want you to go ahead and look at XLE really quick, right? Now let's look at XLE against XLK. We're using some sort of ratio chart, right? We're looking for which sector outperformed which over certain time frames. What did we see when the dot-com bubble burst in 2000 through GFC in 2008? We saw XLE outperforming XLK. What does that mean? The energy sector outperformed the tech sector for almost an entire decade. You would have been better off buying energy-related stocks than buying tech for almost 10 years. What happened post GFC? We were just talking about this. If you weren't in mega cap growth over the last few years, or the last decade rather, you were doing something very wrong, right? Mega cap growth dominated the last 10 years, 15 years of the stock market. But what are we seeing? Potential rounded bottom, a potential floor. And what happens if that 10-year yield starts to get in an uptrend? What happens if we're trading through an inflationary environment? There is a real chance that some of these value areas, specifically energy, potentially financials, are going to see a pop up and start outperforming tech. Once again, I'm not confident enough to call that. I'm just a technical trader. I'm starting to see cracks in the armor of the 60-40 portfolio. I'm starting to see cracks in the armor of just longing Apple as a trader and just fucking off and that's it. There's going to be better opportunities, I think, coming up than just doing that type of stuff. And what I'm trying to do with this video, once again, is prepare you for potentially a different type of market environment. If you want to read through this, it's a really great article. Go to school.stockcharts.com, look up the intermarket relationships and market analysis, read through this entire thing. It's really great. Use this as a blueprint, as a framework. I'm not saying this has to happen, but you can school yourself right now because if you're a technical trader, you're going to be able to see this stuff play out on charts. And if you have this type of information in front of you, obviously you're going to be able to make well-informed decisions. Guys, my name is Hamilton. I'm here with the Trading Initiative. We love diving into stuff like this. If you're a trader without a lot of time and you're trading a relatively large account, you would like some help, this type of analysis, trade ideas, etc., to help you bring in over $10,000 a month, check out the link in my bio. Contact me. We'll have a nice little one-on-one. We'll see if we're the right fit. And if you are, you can join TTI. I appreciate you guys. If you like this type of content, please like and subscribe. Comment below. What do you think? Are we potentially entering a new 10-year yield inflationary period? Or are we overblown and is the Fed going to come in and save the market once again like it has over the last 15 years? Let me know in the comments below. Catch you in the next video.